In this lesson, we're going to discuss cash flow from assets, and this will be part 1, and there will be a second video, part 2. Cash flow from assets is cash that's distributed to creditors and stockholders. So this is the money that's available to them because the firm didn't need it for operations, for spending on fixed assets, or for investing in working capital like inventory and accounts receivable. It's also often called free cash flow, but free cash flow can also be calculated a different way, so it's important to understand what it is that we're calculating. In our course, we'll call this cash flow from assets because we're going to be looking at things that have already happened. And if we're talking about free cash flow, generally we're forecasting cash flows. We'll talk more about that later in the semester. Cash flow from assets can be calculated 2 ways. The first is cash flow to creditors plus cash flow to stockholders. This matches the definition that we just talked about. We said it's cash that's distributed to creditors and stockholders. The second way of calculating it is operating cash flow minus net capital spending minus change in net working capital. So this is the cash flow we have from our firm's general operation, so that's our operating cash flow. And then we subtract from that anything that we invested in fixed assets. And then we also subtract any investments we made in inventory and accounts receivable. So this actually matches our second definition. It's the cash that's not needed for firm operations, capital expenditures, or working capital. So it's what's left over that can go to creditors and stockholders. In this video, we're going to focus on the first equation. So how do we calculate cash flow from assets using cash flow to creditors and cash flow to stockholders? Neither of these terms are on a financial statement, so we're going to have to calculate them ourselves. We're going to start with calculating cash flow to creditors. Cash flow to creditors is calculated as the cash that's actually going to creditors. So when we think about what we're paying our creditors versus the cash we're taking from them, which would be the opposite of cash flow to creditors, we pay them interest. We also pay down our debt, which is the principal paid, but then it's possible that we can borrow from them. And if we take money or cash flow from our creditors because we're borrowing, that's the opposite of to. So that's why new borrowing here has a minus sign in front of it. So if we borrow any more, we're going to have to subtract that from the cash flow we're paying to the creditors. So think of cash flow to creditors as the net effect of cash we gave to the creditors minus cash we took from the creditors. We're going to rewrite this equation as interest minus net new borrowing plus principal paid. Notice that it's just the first equation rewritten. We've taken new borrowing and we've made it the second term and brought the negative sign along with it. And then principal paid is now just the third term. The next thing we're going to do is rewrite this equation as interest minus, and then in parentheses we have new borrowing minus principal paid. Now the reason the sign changes on the principal paid is because once we've put these two terms in parentheses, we factored out the negative of new borrowing, which meant that we also had to factor it out of principal paid. If you want to check that this is correct, you can take the negative sign outside of the parenthesis and distribute it back in. So we'll end up with a negative times new borrowing, that's negative new borrowing, and a negative times a negative principal paid is plus principal paid. So that leads us right back to the second equation, and everything is mathematically legal. So now we're going to rewrite this equation as cash flow to creditors is equal to interest minus net new borrowing. So what we're doing is saying that everything inside that parenthesis is net new borrowing. So it's the net effect of our borrowing and paying back activities. So this is an equation that you might see in your book. In your book, you may see that cash flow to creditors is equal to interest minus net new borrowing. What that really means intuitively is the first equation. It's the money we're paying to our creditors, which is interest and any principal that we're paying back, minus any new borrowing that we may make. If we're a firm insider, it's going to be easy to obtain that information. But if we're not, then we're going to need to look at financial statements to help us, and we can calculate cash flow to creditors as interest minus long-term debt at the end of the year minus long-term debt at the beginning of the year. So if we're trying to calculate cash flow to creditors in 2020, let's say, and we're a firm outsider, then we're going to need to look at the firm's financial statements. The interest will come from the 2020 income statement. Long-term debt at the end of the year will come from the 2020 balance sheet. Long-term debt at the beginning of the year will come from the 2019 balance sheet, because long-term debt on December 31st, 2019 is essentially long-term debt on January 1st, 2020. So that would be the beginning of the year. So you're going to need the income statement for the year you're looking to calculate cash flow to creditors, and you're also going to need 2 balance sheets, the current year and the prior year. Remember, we're trying to calculate cash flow from assets using this first equation, cash flow to creditors plus cash flow to stockholders. We've just talked about how to calculate cash flow to creditors. Now we're going to move on to calculating cash flow to stockholders. Cash flow to stockholders is the cash we pay to stockholders minus any cash we might take from them. So it's a very similar idea as cash flow to creditors. To our stockholders, though, we make dividend payments. It's also possible that we may repurchase shares. So share repurchases occur when a firm decides to go into the public markets and buy back its own shares. They can do this for various reasons, which we'll discuss later in the semester. But dividends and repurchases are both ways for the firm to give cash flow to the stockholders. In addition, the firm may come to a point where it needs to raise additional funds, and it may do that by selling shares. So in that case, it would be raising new equity. So the way that we calculate cash flow to stockholders is dividends plus repurchases minus new equity raised. So again, this is money going to the stockholders minus money coming from the stockholders. We're going to rewrite this equation as cash flow to stockholders is dividends minus new equity raised plus repurchases. Notice that all we've done is move the negative new equity raised to the second term and the repurchases to the third term. We're going to rewrite this again as dividends minus net new equity raised minus repurchases. All we've done here is put new equity raised and repurchases in the parentheses together, and we've factored out the negative. Again, if you want to check that this is mathematically legal, you can redistribute the negative, and we would end up with dividends minus net new equity raised plus repurchases. We're going to call that parentheses net new equity raised because it's the net effect of our raising money activities and repurchasing activities. So cash flow to stockholders is dividends minus net new equity raised. If we're firm insiders, we can use any of these four equations to calculate cash flow to stockholders. If we're not, we're going to have to calculate it as dividends minus common stock and additional paid-in capital at the end of the year minus common stock and additional paid-in capital at the beginning of the year. So we're going to need financial statements to help us calculate this. If we want to calculate cash flow to stockholders in the year 2020, then dividends are going to come from the 2020 income statement. Common stock and additional paid-in capital at the end of the year are going to come from the balance sheet for 2020. And common stock and additional paid-in capital at the beginning of the year is going to come from the 2019 balance sheet. Because common stock and additional paid-in capital on December 31st, 2019 is the same as common stock and additional paid-in capital on January 1st, 2020. So now that we've talked about how to calculate cash flow to creditors and cash flow to stockholders, we have one method for calculating cash flow from assets. In the next video, we'll look at how to calculate cash flow from assets as operating cash flow minus net capital spending minus change in net working capital.